Hi, I'm Sheila Darby, a managing director here at Bisworth. Thank you for joining me for part two of the income approach. This video should follow the video on the income approach part one. So be sure to watch part one before this part two on the income approach. In part one, we've already covered the capitalization of earnings method. And this part two, we're going straight into the discounted cash flow method, otherwise known as the discounted earnings method. So it's important to know that discounted earnings method is the same as discounted cash flow method. This method is based on the fact that the total value of a business, the valuation of a business, is based on the present value of the future anticipated or the future projected earnings of a business. This could be cash flows, earnings, it could be another economic benefit stream, but it's based on the present value of the projected future earnings plus the present value of a terminal value. This is the new and unique part. So we're going to cover this in a lot more detail, but this method does require an assumption for a terminal value. That means at a high level, if we value your business out based on projected earnings of the next 5 years or 10 years, regardless of when that projection ends, at the end of that period, whether it be 5 years, 10 years, 20 years, there is an assumption for a terminal value, all the future earnings beyond that point, unless you're valuing a finite resource, such as a particular natural resources play or a gold mine, for example, that you're going to estimate to the end of life. But this is based on the valuation of a company, your business, that's projected to operate indefinitely. It's a going concern business. And that's why terminal value is so important. So let's walk through what an example looks like. So in this particular example, there is a service company. And this particular service company, we have lots of different service companies that we've worked with over the years that would really fit nicely into this category. This could basically be a restaurant that's getting ready to start a new location. It could be a hair salon business. It could be a marketing and advertising business that's focused on SEO. We have valued a lot of service-based businesses that can have cash flows similar to this. This particular company was a service-based business that had been in business for about 2 years. And based on their profile and their projected growth in their earnings and the investments that they were going to be making, year one projection. So this is year one out. So you're standing here on today's date, and a year out from today, you're anticipating that the cash flows at the end of that period will be $10,500. In year two, from the end of that year one to the next year two, the cash flows will be here for this example was 40,700. Year three, 80,600. Year four, a little over 110,000. And year five, a little bit over 150,000. This example and using a discounted cash flow method is really great to use for companies that are expecting to have fluctuations in their cash flows. They're also great for companies that really have good forecasted earnings or forecasted cash flows. There's reliable projections that can be used for discounted cash flow analysis. It's also really great for companies that are expected to have different growth rates. So there could be a short-term expected high growth rate, and then one that's slightly different for the midterm, and then there's a long-term growth rate. So there's lots of different examples where a discounted cash flow method would be applicable, and these are just a few of them. Another example comes to mind, also companies that have expected high capital expenditures over the next few years. They're doing a large project, something large is coming online, and then they want to project out to that period, and then they use a terminal value thereafter. But moving on in this example, year one of the projected cash flows is the year following the valuation date. That be very clear. If today's the valuation date, year one is a year out from now that's going to be discounted back. For this example, we're going to use a pre-tax discount rate of 24%. And we're also going to assume that the capitalization rate is 24%. This assumes that there's zero future growth. And that's usually rare. that there's zero future growth. But for this example, we wanted to keep it simple and straightforward. So here there's zero future growth. So let's cover step one. Step one for going through this DCF method is to calculate the present value of the annual cash flows. And there's lots of different ways that we can show this, so we can illustrate this. We're going to show you two. This is the first one. And this is showing all the data from top to bottom. You see that today is year zero. So when we discount back, we're going back to today. But here's year one's cash flow, years 2, years 3, years 4, and so on. The sum of all those cash flows is $392,200. And that's an undiscounted amount. That's just summing up all the cash flows. And remember, we are going to assume a 24% discount rate. And there's a science to discounting. There is a mathematical formula. Here it is. So for the sake of time on this video, we're just showing you what that looks like here on the slide. And what does the discounted cash flow look like? You can tell that the further out in time you go, the greater or the more that discount rate is impacting the cash flows. So year one, there's less of a difference, 10,500 versus 8,468. But because of the time value of money and risks over time build, the discount rate impacts the cash flows greater and greater, which makes sense. If you're projecting your company to make 10,000 next year versus 10,000 5 years from now, there is the time value of money of those cash flows, but also the risk associated with those cash flows. So the sum of the discounted cash flows is $175,000 approximately versus the $392,000. This is the difference in time value of money and the risks that are accounted for. Here's another way to illustrate your cash flows. Year one, year two, year three, all the cash flows are laid out. But just to show you visually, to take all those cash flows into the future projected anticipated amounts, discounting back to today, here is the discounted amount. And another great example is if you were to win the lottery, and just for the time value of money and for the risk of the government not paying you in the future, you decide to take a lump sum amount. Well, if you had won $392,200, the sum of all these cash flows, if you wanted to take that payout today, that could be something like $175,000 if a 24% discount rate was used. So two different ways to lay this out. I know we're all visual learners and we learn differently, so we wanted to lay this out two different ways. But let's move on to step two. Step two is calculating the present value of the terminal value. Remember, we had a projection of cash flows out for 5 years, but the company does not stop operating in 5 years. The company is a going concern. It's going to continue to operate indefinitely into the future. So how do you put a value on that? Well, that's through the terminal value. You look at the benefit stream in the last year. So if you go back to year 5, you see that there was $150,300 that was projected. And you had a terminal growth rate of 0% in this example. So in this example, the terminal benefit stream is $150,300 because there's zero growth. But if there was a 3% growth, this would basically grow by 3%. So it would be something slightly higher than $150,000. Now you need to calculate a terminal discount rate and know the terminal growth rate. And we've stated what we already know here. And this is used, the discount rate and the growth rate is used to calculate the capitalization rate. So here the capitalization rate is 24%. If the growth rate had been 3%, it would be 24% minus 3%. But here there's 0% growth rate. So the capitalization rate matches the discount rate. But that usually is not the case. So here the terminal value in the last year is $626,250. To do the math, that's $150,300 divided by the 24% discount rate. And now you need to discount that back to today's value. So discounting that back, we're applying the discount rate in period 5, and you're going to get a value of $213,619. Again, what is this amount? This is all the future years beyond year 5 that the company will generate. discounting back that amount, the $626,250 that you're going to earn for all future benefits, discounting back today is $213,619. So step 3 is to add both the present value of the future cash flows, discounted cash flows, to the present value of the terminal value. So if you take those two amounts, $175,000, and add it to the $213,000 and change, you will get the total indication of value for that company, which is approximately $388,000, or if you're rounding, $389,000. So that is the indicated value, equity value for this particular company. So I hope you found these examples helpful. I know we covered a lot in these videos. So part 1, you saw the introduction of what the income approach was, and you saw a quick example of the capitalization of earnings method. In part 2, you saw the example of the discounted cash flow method, or otherwise known as the discounted cash earnings method. I hope you found these videos helpful. Valuing businesses can be complex and overwhelming. There are 3 generally accepted approaches: the asset, the income, and the market. But within each one of those approaches, there are many different methods that can be used to value a business based on the circumstances and the specifics of your particular business. So if you would like to work with Bizworth, please don't hesitate to reach out. You can schedule a free appointment on our website at www.bizworth.com. If you found this video to be helpful, please do like and follow us on Facebook, LinkedIn, and our YouTube channel. Thanks again for watching, and stay tuned for the next video in our series that covers the market approach. And that's the last approach in this 3 generally accepted valuation approaches. We've already covered the asset, we've covered the income, and now we're headed into the market approach. Thanks a lot.